We'll get going in a moment. Let's see if any students join us. Wait another minute or two, and then we'll get started, okay? Great, tell we have a visitor. Hi, Carrie. Hey, there she is. Hiya. You're mute.
Okay, there we go.
Yeah, how was your week in the wild?
It was great. It was beautiful. We had good weather and saw lots of wildlife and beauty and lots of dolphins and a whale on the way back.
Oh, wow. Well, what a great trip. Right across the bay here, huh?
Yeah.
Amazing. All right. Well, I hope you're all refreshed and ready to go into chapter 5 it is.
Yes. And everything okay with you? I know you were not here last Thursday.
Yeah, it went okay. I hurt my foot. Now my foot's getting a little better finally.
Oh, goodness. That doesn't sound as fun.
No, it was very... I thought for sure something was broken, but they're telling me no. Okay, hold on. Let me share screen here. Whoops, I got the wrong thing. I want chapter 5, not chapter 6. Okay, hold on a second. Chapter 5. Come on, chapter 5.
These two together broke the branch.
Okay, chapter 5 is coming up.
Okay.
Share screen.
So I had a question on, while you're looking, on the homework or the quiz or whatever.
Yeah.
Okay, so the question was about receipt stubs, carbon copies of receipts, cash register tapes, memos of cash register totals, provide information about, and I put purchase of goods or services, but that was wrong.
I think they were just asking for something simpler than that. Source documents was
No,
probably...
the choices were cash payments, accounts payable, cash receipts, purchase of goods or services. And
Read them
purchase of
again. Read them one more time.
cash payments, accounts payable, cash receipts, or purchase of goods and services, which is what I chose. But it was wrong. So
Could you read the question one more time?
receipt stubs, carbon copies of receipts, cash register tapes, or memos of cash register totals provide information about, and then it was cash payments, accounts payable, cash receipts, purchase of goods or services.
And you put down cash receipts?
I put purchase of goods or services.
That's cash receipts, I think, that answer.
Okay.
Yeah, everything you mentioned there had to do with receiving cash, the cash register tape.
Okay, so if you purchase something with a credit card or with cash, it's same, right? It's considered cash.
Yeah.
Okay. All right.
All right, so you got on that?
Yeah.
All right.
Okay. Oh, All right, so if you're going from the general journal to the general ledger,
Yes,
and
posting.
you're marking down cash, and then you're doing the balance, right? So it's always in the debit column. Could it ever be that if you can't like overspend your cash, right?
No,
Okay, so then, because you'd have to pull the money from somewhere else. Like it wouldn't shift over to the credit column.
well,
Right,
it could if you made a mistake or you're
Yeah.
floating checks.
Yeah,
Yeah,
but so then if it becomes a negative balance,
credit balance, yeah.
a credit balance, then you would shift it over to the other column in the general ledger.
Yeah, you just have to show it for what it is, a credit balance.
Okay,
And that would set off all kinds of bells and whistles, because you should never have a credit balance in cash.
okay,
The only way is if you make a mistake, you write a journal entry incorrectly, or more likely you're floating checks, if you know what I mean.
yeah,
You write a check without any money in the checkbook, hoping to catch up the next day with cash from a customer to cover it. And then, of course, there's always the possibility of theft,
right,
and that's the one you really have to be scary about.
right.
Does that answer the question? No, I mean, it would end up just as a credit balance.
Right.
And I got yelled at by the auditor one time, and I still defend myself to this day. At the end of the month, we had a negative cash balance of about, I don't know, $90,000.
Oh my
But
God.
I knew there was a check coming in the next
Yeah.
2 days. I knew it to an empirical certainty that would
Right.
cover that.
Mm.
But the auditor, he made me reverse that entry and come up with an explanation of why I did it, and
Wow.
restore it back to a debit balance. So he didn't like me floating checks, that's for sure.
Yeah. Wow. Okay.
But sometimes you got to do it.
Yeah. Like I have had situations where, like the person I, work for, would get paid in cash, and like when she was traveling, right?
Yes.
She would get paid in cash when she arrived, and then she would purchase things while she was there with cash. But I wasn't getting the full total of how much she was paid. I was just seeing the receipts, right? Like
Okay.
the money was being spent with cash. And so like on her credit card, but I hadn't seen the income yet. So I was tracking the receipts of what was being spent before
Right.
I knew what the cash income was.
Yeah, that can be a little bit of a disconnect there.
Yeah.
A little bit of a problem. When somebody travels for work, it's best if they had their own company credit card, a credit card that's different than their personal one, if you can do that.
Yeah, she does.
Or just take out a cash advance
Yeah.
and then account for that money. So she
Yeah.
was doing everything on the fly, which makes it a little bit trickier for you.
Right.
Yeah. She might come back to you and say, I spent money on this and I want to be reimbursed for it. And you don't see it on the credit cards because maybe she forgot she paid cash for it.
Right. Right.
Maybe she ran into the airport and grabbed a quick donut and cup of coffee, which probably cost her $38, right?
Right.
At the airport.
Right.
And, didn't have the backup for that. So, but yeah,
Right.
that's kind of tough.
Mhm.
But you ready for some tough work here now?
Yes.
Okay, we're going to go into what are called adjusting entries. I think
Mhm.
we're back on schedule,
Okay.
and there's a test not next week, but the week after on chapters 4, 5, and 6. So chapter 4, we learned about journal entries and how to post them to the general ledger, right?
Right.
Now, what you're going to learn here, Carrie, is that at the end of the month, when a company runs a trial balance,
Mhm.
by definition, that trial balance is incorrect and incomplete. Because what we haven't shown you yet are what are called adjusting journal entries. There are certain entries that can only be made at the end of the month. You can't do them during the month,
Mhm.
not without a lot of clumsiness. So adjusting journal entries are normal for almost every company in the world, okay?
Mhm.
And let's see if we can get into them. and get you going here. Prepare end of period adjustments. One of the adjustments we're going to make is for equipment wearing out. We're going to write a journal entry for depreciation expense. You're going to learn we're going to debit depreciation expense and credit the contra account called accumulated depreciation. Remember the prepaid insurance and the supplies we've been putting into the balance sheet?
Yeah.
The adjusting entry now says, how much of those did you actually use? And thus has to be recorded as an expense. So we're going to be using up those prepaids. And then you're in the workforce accruing some wages. Employees earning wages that have not yet been paid. You worked the last week of the month, say, for your employer. You're not going to get paid though until next week or even the week after that, right?
Right.
But when did you work those hours? You worked them this month, September. Okay. You worked the last week of September. That is where the dollars have to be recorded into the general ledger. And that's going to be done with an adjusting journal entry called an accrual. Okay.
Okay.
So these events have not been entered into the accounting. Adjusting entries must be made. And there's three principles involved here. The revenue recognition principle, which is we recognize revenues when they occur, when the product has been delivered, when the service has been rendered, has nothing to do with the cash. Same thing with expense recognition. You recognize expenses when they're incurred, when they take place. And that brings us to the matching principle. The matching principle matches revenues and expenses. So that's what this is all about. That we put out a financial statement that's correct in that all of the revenues that were incurred in the month or recorded, and so are all of the expenses for a clean look at the bottom line. Revenue recognition principle. Revenues recognized when earned, regardless when cash. It's when you provide the product or the service. Expenses are recognized when incurred, regardless of the cash. Expenses are generally considered incurred when the services are received or assets are consumed. One example would be the electric bill. At the end of the month, we don't have the electric bill yet. That's not going to come until maybe the 25th of the following month, if it's like in other businesses. But we have to recognize that we had electric expense that month, and we must estimate a number and accrue it.
Okay, so I never do that. Like, I don't keep track of all the supplies that are used or anything like that. You know, I buy supplies and they get used up over time. So, I mean, is every business supposed to do that?
Not really. It depends on what kind of supplies you're buying. When you buy your supplies, I'm quite sure you put them right into expense.
Yes.
Which is typical. Yeah, that's typical. But for purposes of teaching these adjusting journal entries and learning the accounting, we want you to be familiar with prepaid assets, and supplies can be a prepaid asset. You know, Chipotle, when they go out and buy supplies, they buy millions of dollars at a time.
Right.
They may actually be a company that has methods to track their supplies month by month.
That would make sense.
No, yeah. I don't think they send somebody out to count all the straws or anything, but right. they probably make a good faith effort to put the prepaid to put the supplies in prepaid, and then at the end of the month, a good faith estimate of how much they used of those supplies. But what you're doing is very typical. You know, if your supplies are that expensive that you have to physically count them every month, that's a little dicey, to be honest with you.
Yeah.
And what's the matching principle? Revenues and expenses. On the test, if I ask what the matching principle is, what does it match? It matches revenues and expenses. Okay. And that provides the proper measure of net income. So now let's see what we have going here. We know what a fiscal year is, right? It can be any 12-month period that a business chooses to use as their business year. Okay, let's take a look at our first adjustment. Mitch, I'm kind of chuckling at your question because you hit the nail on the head there. Mitch purchased supplies for $80. So he's gonna, for $80, he's putting it into his inventory, basically, okay?
Mhm.
He's recording that as a prepaid asset. So he debited it to supplies, which is an asset. Supplies is an asset, supplies expense is the expense. According to an inventory of supplies, there are only $20 left on hand at the end of June. So how many did he use then?
60.
Yep, 60. So unless there's an adjusting entry, $80 of supplies would still be on the balance sheet. Assets would be overstated and expenses would be understated if we did not do this.
Mhm.
So look at our journal entry. We're going to debit supplies expense and credit the prepaid supplies account. Take a look, supplies expense. You can read those numbers, Carrie?
Yeah, my glasses.
Okay.
There. Now I
Yeah,
can read.
there you go. Now, boy, your glasses really made them big now, huh? Okay. There we go. Supplies expense was $60.
Mhm.
And look what we did to the supplies, the asset. The asset has now been reduced to $20. Make a little bit of sense?
Yeah.
And here's our journal entry, debit supplies expense, credit supplies. So that's the first of a couple of journal entries we're going to be talking about. Prepaid insurance. Prepaid insurance, he paid $700 for a 10-month liability. That $200 is a misprint. That should be $700 up on top. But he
Okay.
paid $700 for policy. So this thing for 10 months is going to be $70 a month.
Mhm.
Every month that we had insurance, it's going to cost us $70 in expenses, right?
Right.
So there's our journal entry. We're going to debit insurance expense, credit prepaids. Your adjusting journal entries, for the most part, Carrie, are a
Mhm.
search for unrecorded expenses. So you're almost always debiting an expense, okay?
Right. And so, like with insurance,
Now, this companies do, believe me.
do.
With insurance, yeah, absolutely.
So they have to, I mean, okay, so you pay for the insurance, it's you got it for 10 months. If you put in a claim at month 1 or month 10, you're still going to get the same you know, results, right? Like,
Right, right.
so it seems it seems kind of unusual why you would have to expense the insurance every month, because the value of it doesn't actually change. You know, it has the same value at month 1 as it does at month 10, as far
No,
as.
it loses its value in terms of how long it is. It loses its value, it loses $70 of its value every month. In other words, you start off with 700, the next period you only have $630 worth. You're correct. If you file a claim in the first week or the last week, you're going to get the same result.
Yeah.
But for purposes of accounting, we are incurring that expense.
So it's
We
kind of
have
like
that. Go
you're
ahead.
getting that much closer to having to renew again or something like that.
Exactly right. Exactly right. By definition, prepaid insurance is a prepaid asset. It would be
Yeah.
nice if you had an automobile accident and then you could go buy insurance to cover it. It doesn't work that way.
Right.
And where I worked for most of my working world with some, with factories, we had maybe a dozen different insurance policies. We had
Yeah.
everything from, hazardous insurance to workers' comp and intellectual property, things like that. And I had them out and, I had them all laid out in Excel with the lapsing. And every month we had to figure out how much of these insurance policies lapsed. I think
Wow.
that's the word, as it's
Mhm.
lapsing.
Okay.
And again, don't get scared by the journal entry. It's not that tough. You debit insurance expense
Mhm.
and you're crediting that asset. That asset is now only worth $630 at the end of the first month. And you're going to do this 9 more times to get the prepaid insurance down to 0.
Mhm.
And the insurance expense is going to go up 70 each month. Okay.
Okay.
Now, here's one we can all sympathize with, or not sympathize, empathize, because we've all done this.
Mhm.
We have wages expense of $6,650, and there's another typo, $1,650. By the way, we're using a new publisher in 230. I think I mentioned this.
Mm.
They are so filled with mistakes on the slides. It's very, very, very distracting, and the faculty is having a revolt here. But
Yeah.
anyway, I digress. Rowan had already paid $1,650 to his employees, okay? So that's the expense that's showing as of the 27th of the month.
Mhm.
That $1,650, he recorded and he paid it. We're done with that payroll.
Okay.
But people worked on the 28th, the 29th, and the 30th of June. They worked 3 days.
Mhm.
And during those 3 days, they earned another $400. Because they worked it in June, we have to record that expense in June. We can't ignore it.
Mm.
We can't say, well, we'll wait till we pay them. No, we must accrue it right now.
Wow.
So we're going to write a journal entry to
Mhm.
debit wages expense and credit wages payable.
Okay, so is this difference between if you do your business on a accrual basis or a cash basis?
On a cash basis, it would be totally different.
Okay.
Yeah, totally. Like I said, I don't want to get into
This
cash
I
basis.
do is a cash
Yeah,
basis. Okay.
cash basis, everything's recorded when cash moves.
Okay, got it.
Under a cash basis, you could have a month with no sales and a tremendous loss because you get the idea.
Yeah. Okay.
So take a look at this adjusting entry. Adjusting entries can be tricky at first. They can be a little intimidating. So what did we do? We have an employee who worked 3 days at the end of the month. He or she earned $400, and we're going to debit wages expense to record the expense in the proper period and credit wages payable, okay? Now you can have a lot of other accruals. You might have to accrue, for example, your utility bills. You
Mhm.
might have to accrue rent or something. So there can be a lot of accruals at the end of the month. What
So
they have
then-
in common is they all debit an expense and credit a payable.
Okay, and so wages payable would be under liabilities, right?
Would be a liability, right? It's a temporary liability in this case. Yeah.
Okay.
Yep. So here's a key point here. They had already put 1,650 into the payroll expense, okay?
Mhm.
That was the payroll from the first of the month through the 27th. Now we're layering in that last 400 to bring the total up to 2,050. And wages payable. How much did we owe at the end of the month? We have to do it for legal reasons too. I
Mhm.
mean, if we fired this person at the end of September,
Mhm.
we owe them the money. We have to hand it to them. If
Mhm.
this person quits, we pretty much have to hand it to them.
Mhm.
If the place went out of business that day, we'd have to. So it's a legal liability as well. All assets are recorded at their actual cost, and the cost remains on the books as long as the business owns the asset. No adjustments are made for changes in the market value of the asset. What we're saying here is we buy a piece of machinery for $100,000. That machine is going to remain $100,000. We're never going to credit the original cost of the machine. Never.
Mhm.
But we do have to record the depreciation expense.
Right.
So we're going to do that by a journal entry that recognizes supposedly the wear and tear on the asset.
Okay, so wait, you said a machine, you pay $100,000, and what doesn't change about that
You'll never credit that.
Never credit that.
You'll never touch that unless you sold it. You'll never touch that.
Okay.
But what we do have to reduce, Carrie, is the value of that asset. And we do it through the contra account called accumulated depreciation. Okay.
Mhm.
And that's what we'll talk about in a minute. So the first thing we want to talk about with depreciation is assign what's called the useful life to an asset.
Mhm.
For example, you buy a company car for your one of your salesmen, and you know this guy's a wild driver and you know he's going to put a lot of miles on it. So maybe you say that car is not going to last more than 5 years.
Mhm.
That would be the useful life. We divide that cost of that car by 5 years, and we get the annual or periodic depreciation expense. We're going to be just working with straight line here.
Mhm.
So a useful life expires as a result of wear and tear, or the machine is no longer doing anything for us.
Mhm.
The expense should be recognized, and the value of the asset should be reduced over the useful life. But we said we never reduce the asset. What we do is increase the contra account called accumulated depreciation. And
Okay.
by the way, when we're depreciating an asset, the net
Mhm.
book value, Carrie, has nothing to do at all with the true market value of what that asset is worth, okay?
Uh-huh.
Has nothing to do with it.
Okay.
We had an asset that was depreciated before I was born at my last company,
Mhm.
but it still worked.
Mm.
Hollywood used to give us orders for things like wanted posters. It was a real old-fashioned linotype machine.
Wow.
I don't think they need it anymore with, the graphic arts now, but in
Right.
those days, that was considered a cool thing to have. And
Sure.
people would come by and try to buy it from us, but we never sold it.
Fun. So,
What
so
is
Jennifer, you said you would increase accumulated what? What did you?
depreciation?
Depreciation. Okay.
Which is an asset account, but it's a contra, meaning it's an asset account with a credit balance.
Mhm.
So it increases with a credit. And all contra accounts are married to somebody, okay?
Mhm.
In this case here, accumulated depreciation is married to the original cost of the asset. It's married to the building. It's married to the equipment,
Mhm.
okay? And we want to take those two as a pair to come up with the net book value.
Okay.
So step one is to come up with a useful life. Now, the useful life has to be reasonable.
Mhm.
You can't buy a gigantic machine for $1 million.
Mhm.
And the boss said, we're having a good year here. Why don't we expense that whole machine in 1 year? And that way we'll show a profit of 0. We won't have to pay any taxes. And we still know we made a lot of money. No, you can't do that.
Uh-huh.
It has to be a systematic and rational basis for the useful life. The IRS provides guidelines, but they're just guidelines, okay?
Mhm.
You can shimmy it a little bit.
Mhm.
This machine should last us 20 years. Maybe we can get away with a life of 15, but it has to
Yeah.
be reasonable, okay?
Mhm.
So we come up with the useful life. And what is depreciation? It's the attempt to match the assets expense out against the revenues, part of our matching principle. We want to recognize the wear and tear on that machine this month. And
Mhm.
depreciation expense is based on estimates. It's all estimates. Depreciation expense is based on estimates of the useful life of the asset and the salvage value involved. We'll talk about salvage value shortly. Depreciation expense has nothing to do with the actual wear and tear of the machine, okay? Salvage value, also called residual value. This is the amount of money we think in the future somebody will give us for this machine when it's fully depreciated. We bought that salesman that car, right?
Mhm.
And that guy, he's in charge of our Western territory.
Mhm.
He's driving 100,000 miles a year through the worst kind of weather in the Arizona desert. And he's going up into the mountains in Nevada and Upper California. And at the end of 5 years, that car is going to be beat to hell.
Mhm.
But we're pretty sure a junkyard will come in and take it off our hands for, say, $500.
Mhm.
That's what's called salvage value. And
Okay.
that has an important consideration because you do not depreciate the salvage value. And we'll get into that more in a bit. The depreciable cost is the original cost of the asset less salvage value. So you paid $95,000 for this nice car for your salesperson.
Mhm.
If the salvage value is 5,000, you only depreciate the 90 is what we're trying to say, okay?
Say that again.
You bought an asset for, say, $95,000.
Yeah.
And you think at the end of 10 years, someone will pay you $5,000 to take it off your hands.
Mhm.
That's the salvage value. You will
Okay.
take the 95 minus the 5,
Mhm.
and that 90,000 is going to be called the depreciable cost. That's
Okay.
the amount you depreciate.
Okay.
You never can depreciate an asset below the salvage value. Once it reaches salvage value, you're done depreciating.
Okay. And then what if you you anticipated that the scrap value would be $5,000 and it turns
Right.
out it's $10,000.
Well,
Like,
that's good. Then that's called a gain on a sale of fixed asset.
okay.
And when you get
And if,
into
and then if it's below that, if it's only $2,000, then
the loss,
you make that adjustment at the time of getting rid of that asset.
yeah, of course. What happened, like in your first example, somebody gave us $10,000 for it. We're going to debit cash 10,000. We're going to credit that piece of equipment 5,000, right?
Yeah.
And then the other 5,000 is going to be called gain on sale of asset. That'll be a revenue account.
Okay.
Same thing if it was a loss. We would debit cash for 2, credit 5 the asset. Now we're left with a debit for 2, and that would be a loss on the gain of a fixed asset. That's a good question, and we do quite a bit of that when we get to this chapter in 230, when we get more detail on the world of the adjusting entries and sales of fixed assets. Straight line depreciation. Straight line. There's all kinds of different methods. There's straight line. There's double declining balance. There is units. There's some of the digits. There's all kinds of different depreciation methods. We're going to work with the most common one and easiest one, called straight line. So Mitch bought motor scooters with an estimated useful life of 5 years with no salvage value. So that makes it easy. The whole 4,800 is going to be spread over the next 5 years. Assume that a full month's depreciation is recognized monthly, in which the asset is in the month in which an asset is purchased. The depreciable cost is thus spread over 5 years or 60 months. 4,800 divided by 60 months is $80 per month, right?
Mm-hmm.
Our journal entry is going to be a debit to depreciation expense and a credit to accumulated depreciation. So the asset was $4,800, right?
Mm-hmm.
And we said we're never going to credit that fixed asset. Never, unless we sell it, okay? So at the end of the first month, the net book value went from 4,800 to 4,720, right?
Right.
The next month, it's going to go from 4,720 to, I don't know, 4,640, whatever that number is, right?
Yeah.
So that's what we're talking about. The 4,800, the original cost of the asset, that is never going to be decreased. What's going to be decreased is the net book value, the
Okay.
value carried on the books and accounting records. It's the original cost of the asset minus accumulated depreciation. It's also called the undepreciated amount, the undepreciated cost. It does not represent, has nothing to do again with the market value or the selling price of that asset.
Mm-hmm.
That asset could be made of a rare metal that's become valuable today. It could be worth $1 million. We paid $10,000 for it. It's worth $1 million today. We cannot record that gain until we actually sell it. Okay. So the key point is the depreciation expense and resulting book values have nothing at all to do with the real world.
Okay.
Here is an explanation of accumulated depreciation. It's a contra asset account. From the Spanish word contra, that means contra. Okay. It means the opposite.
Yeah.
It has a credit balance. That means it's married to something. It's contra. Its contra partner in this case would be the machinery or the equipment or the building, whatever it is.
Mm-hmm.
And it has a credit balance, and we're going to deduct it every month. We're going to increase, rather, the accumulated depreciation every month. But in so doing, we're reducing the net book value. Make sense?
Yes.
The net book value, again, is the original cost of the asset minus the accumulated depreciation. So the appropriate journal entries are debit to depreciation expense, credit to accumulated depreciation. Take a good look at it. Depreciation expense, you debit $80,
Mm-hmm.
you credit accumulated depreciation. Since the 4,800 is never going to change, what's changing is the net book value.
Okay.
So we're going to do this every month for the next 60 months.
Wow.
And then after 60 months, the net book value of this thing would be 0 because the accumulated depreciation caught up to it. And in the meantime, we're going to be writing a journal entry every month for $80 expense.
Got it.
So the expense is by itself, that's just a one-time thing every month. The accumulated depreciation will grow and grow and grow until the asset is fully depreciated.
Okay.
And go ahead, question.
Okay. So then at the end of that, say, you know, the machinery, whatever, is still working. So it's been completely depreciated, but it's still being used.
Absolutely. Right? Absolutely.
And that original 4,800 is still there until you get rid of it.
Until you, exactly right. Until they call what disposal.
Okay.
Until you arrange for what's called the disposal of the fixed asset, either by sale or you just junk it.
Okay.
But yeah, an asset can be fully depreciated and use it forever, like that linotype machine we had at T&B. And they're just showing you an expanded chart of accounts, showing you the new accounts that you were introduced to. Accumulated depreciation. Look over here at the asset numbers, right? Assets typically begin with a 1, right?
Okay. Yeah.
We get to delivery equipment, we got 185, but look at the depreciation, 185.1.
Okay.
That means they're officially in a committed relationship, those two, okay? They're together.
Okay.
Liabilities 2, equity 3, revenues 4, expenses 5. The reason I pointed out is that is very typical, very, very normal.
So then, okay, so supplies expense. Okay, so there's supplies, and then
That's the asset,
yeah, and then there's supplies expense.
which is the expense.
Okay, right. Okay.
Yeah, the supplies are the supplies we haven't used yet. At the end of the month, we went out and Chipotle all over the country went out and they counted the napkins and the straws and the paper plates, and they figured out how much they used. I would think,
so like accumulated depreciation, you have that like delivery equipment, and then accumulated depreciation is also an asset account, but supplies and supplies expense are not like married in that same way. Right?
Yeah, they sort of are. They're not quite. No, they're not married quite the same way. But when you use up the supplies, it becomes supplies expense.
Right.
Okay. Just like with the insurance, you use up the insurance, it becomes insurance expense.
Right.
Yeah. It'd be nice if you could buy insurance after the accident, huh? Then
yes, it would.
There was a show that makes me chuckle on television. Third Rock from the Sun. Have you ever heard of that program? It was on about.
Yeah, that was funny.
I mean, I've only seen it a few times, but it made me laugh about Martians or something trying to acclimate themselves. And John Lithgow's character had an automobile accident. Someone said, "Well, you should have had insurance. It would cover it." And he went to the insurance guy to buy the insurance, and he got in an argument with him. And he said, "That's the kind of scam you people are pulling, huh?" He walked out in anger. He couldn't get insured. Anyway, what happened here? Okay, now we just post the adjusting entries. And you'll find adjusting entries a little tricky when you go to do the homework. They're going to make you think a little bit.
It does.
Well, there we go. There's our adjusting entry for the supplies expense. We debit supplies expense and we credit the prepaid supplies. So here we go. Debit supplies expense 60, credit supplies, and I'm just showing you, we know how to post them to the general ledger now, right? That's what we did in chapter 3. Chapter 3 and 4, okay?
Mhm.
So I don't think there's any mystery there.
So tedious when you have to do it by hand.
We used to do it in pencil. Can you imagine that?
Yeah.
We had these 15-column worksheets,
Wow.
and then they would fold up on top like an accordion.
Wow.
All right, Bob, get the okay, and for depreciation especially, you know, you had a piece of paper with maybe 12 or 15 or 20 different assets, say, right? And then January 1972. Okay, this one you depreciates 50, this one depreciates 100. You bring the balance, and then you repeat. It was a very pencil intensive world then.
Really?
A lot of people thought that when computers came out, you know, more computer, and I might have talked about this a little bit, more computer power came out, they said, wow, we're not going to need that many accountants, you know, QuickBooks will do all this for us. No, it turned out it was just the opposite, because now there was so much more data to be mined.
Yeah.
There was so much more analysis that could be done,
Right.
so much modeling you could put together. So,
Mhm.
oh, you ready for the worksheet, huh? We're going to put together, boy, I tell you, I wish this class was in person because I love to give this out, the spreadsheet, give you an idea of what we're talking about.
Mhm.
We're going to look at a 10-column worksheet, 10
Wow.
columns. And it's a divide and conquer type thing. It pulls together all the information needed to enter the adjusting entries and prepare the statements. Not a financial statement, just a worksheet, typically Excel.
Mhm.
It's like a trial balance. In fact, it's going to begin with the trial balance, typically in a 10-column format.
Wow.
So these are your 10 columns right here. The first 2 columns are simply going to be the trial balance, okay? Then the next 2 columns are going to be blank. That's where you're going to post your adjusting entries into that second pair of columns.
Mhm.
When you finish that, you're going to take the original trial balance,
Mhm.
the unadjusted trial balance, and debit and credit the activity to come up with the ending adjusted trial balance. And once you have that done, the next 2 columns are simply the income statement, and then the last 2 are the balance sheet.
Okay, wait, so okay, so 5 and 6 are the adjusted trial balance.
Yeah,
And what are 7 and 8?
7, 8, there's your income statement. You go to that new trial balance and you
Mhm.
go to your first revenue account, and you know everything with that and below is your income statement. Everything above is the balance sheet.
And what's the 9 and 10?
Balance sheet.
A balance sheet. Okay.
Yep. Yep. I don't know if the homework makes you put this together at all in terms of a worksheet. It might.
Mhm.
So you put the worksheet together, you put a heading on it, huh? Prepare, given some rules for underlining. Let's not worry about that. Step 1, right?
Mhm.
Yeah, place a single rule across the trial balance. So you're going to start off with the trial balance. So the first 2 columns are given to you. They're going to be given, okay? Then the next 2, prepare the adjustments, record the adjustments. Make sure that each adjustment is on the same line as the account. It's easy to go off by 1 if you're not careful with lining it up with the eyes. And then you can do the adjustment column and get that total. And here is the 10-column thing right here.
Mhm.
Okay, I hope you, I'm not sure if you can really read that too well.
I don't think it's well. Yeah, I got it.
Okay, let me just move this over here. Okay, So you're given the first two columns, the trial balance, okay?
Mhm.
Now look at what we're doing in columns 5 and 6. All we're doing, or columns 3 and 4, I guess, we don't count the trial balance column. In columns 3 and 4, you're posting the entry. Look at supplies expense. Let's do the debit. Remember we had that $60 expense for supplies?
Yeah,
We debit supplies expense and we credit the prepaid supplies.
mhm,
We had the $70 for insurance expense. We debit insurance expense. We credit the prepaid insurance.
mhm,
We had depreciation expense of whatever that number is, $80,
yeah,
and we credited the accumulated depreciation. Notice you want to put the credits in the credit side, you know, obviously put them on the right side. And then we had the wages payable. This person worked for $400 worth. We have to record that expense, and that's the credit to the payable. This whole worksheet, this is the hard part right here,
mhm,
putting in your journal entries.
mhm.
Once you have the journal entries in this thing is easier than falling out of a chair, because all you're going to do is go to every line and move it over.
Right,
Cash. Well, we don't adjust cash the same way we adjust supplies. We don't send somebody out to the safe. Carrie, would you go out to the safe and count the cash? And you come back and you say, we have $807,000, boss. And I say, well, we were supposed to have 850. Okay, so we'll write off the 47. No, it doesn't work that way. Cash is to the penny. Same thing with accounts receivable. So you just bring over the 470 to the debit. You bring over the whatever number that is, 3,100 over to the debit side.
mhm.
Here it was 80, credit 60. You'd have a balance of 20 there. Okay.
Got it. Okay,
So now so that takes us through the hard part. Now
Mhm.
we prepare the adjusted trial balance. Extend those debits and credits that are not adjusted directly to the appropriate adjusted trial balance.
okay.
And here we go.
Mhm.
I don't know why this thing will not let me zoom. I used to be able to zoom it, and when it zooms, it makes it nice and clear.
Right, now you are. There you go.
Yeah, okay. So take a look at it.
Mhm,
470, 3,100, 80 minus 60. Prepaid insurance, 700 minus 70.
mhm,
Bring the delivery equipment. Look at your accumulated depreciation. It was 0 plus 80 credits, so that's a credit.
mhm.
You bring them all over. Of
Okay.
course, the totals have to equal, right?
Right,
Debits must equal credits up to this point. So you get the idea what we're trying to do with this worksheet?
yeah,
It's a little bit of a pain in the neck, no question about it. Now we can do the income statement and balance sheet. Once we have the adjusted trial balance, we can go, boy, we're really done. All we have to do now is publish the statements.
mhm,
We did the hard part. And here we go. Remember what we said about our income statement?
yeah,
It starts right after the drawing with the first revenue.
mhm,
So there's our income statement, 8,000. Here are our expenses. $8,000, right?
mhm.
Minus 3,360 gives us a profit of $4,640, okay?
Mhm.
And then all you do with that is add that to the 3,360 just to balance out those two columns, okay?
Mhm.
Because if we've done things correctly, when we do the balance sheet and bring everything over, we should be off by the same exact amount on the credit side, which is what we want to see.
Okay, I have a question. Under the income statement, so why is the 4640 on the debit side?
Because we're going to have to take that 40,600. We're gonna have to take the $4,640 net income. We're gonna have to debit it to close it out. We're not up to closing entries. That's the next chapter. But what you're gonna learn is we're gonna zero out the income statement with a debit and then credit equity on the balance sheet side. This is the process of bringing this over to equity. Remember the equity statement?
Right, but like, you know how in the like those T accounts, you put, like, if there's more credits than debits, then you put the balance on the, okay, say if there's more credits than debits, you pput the balance on the credit side, right?
High man wins, right?
So here, high man is on the credit side, but the 4640 is on the debit side.
Right.
Like,
So
why
we have,
wouldn't-
so we have definitely have a credit balance, right?
Right. So why isn't the 4640 on the credit side?
The 4640 on the, you mean on the debit side here, you talking about?
Yeah. Like,
Because,
like,
because what you're gonna, because we're getting a little ahead of the next chapter. Because at the end of the month, Carrie, we have to take that net income out of here and move it into equity through the equity statement. And that's gonna be with a debit to all, we're gonna debit all the sales accounts and we're gonna credit all the expense accounts. This is the mechanism for moving the income into the balance sheet. This will be explained a lot more clearly in the next chapter when we go into what are called closing journal entries. But what we're saying here is we have a profit of 4,640. Hooray. We know that 4,640 is going to increase our equity, right?
yeah.
So we put it over here as a credit and we put it here as a debit. And then by so doing, we add the two columns down and then everything balances out. It's a little confusing when you haven't seen chapter 6 yet.
Okay.
But that's a good observation. But we understand that the stockholders' equity is your beginning equity, which in this case was $5,000 plus your net income of 4640 minus the drawing here of 3,000. That's what we're doing, moving that 4640 into the balance sheet. Okay.
Okay. Yes.
Yeah, they have a lot of these slides on finding errors. I'm not going to worry about that. The only one I like is dividing by 9, which you've heard me talk about before, right?
Mm-hmm.
Learning objective. When they write a chapter, doesn't the learning objective go to the beginning of the chapter, not toward the end? Journalize adjusting entries from the worksheet. The worksheet helps the accountant organize the end of period, and it's not really a financial statement of any kind. The accounts are not adjusted until a general entry is made and posted. What they're telling you there is putting it on the worksheet does nothing. You also have to actually put it into your general ledger and post it, obviously.
Mm-hmm.
And then here we go. Look at this. We can now do our financial statements, huh? So here they're showing you the journal entries. So we learned 4 journal entries: debit supplies expense, credit supplies,
Mm-hmm.
debit insurance expense, credit the prepaid insurance, debit wage expense, credit accrued wages payable, or just wages payable, I guess. And then the other one, the easy one, debit depreciation expense, credit accumulated depreciation. Okay.
Yep.
And we're not going into cash. We're not going into cash. That would be irresponsible of us to do that.
Why?
Huh?
Why do you not? Oh,
Because
mean-
cash is not GAAP. Cash basis, if you try to run a business on a cash basis, you'll cash basis yourself out of business before you know it, because you're not going to be able to come up with accurate financial statements, because everything follows the cash. You might have a big sale in the month of May,
yeah.
but you're not going to get paid until September. Nothing, you're not gonna have any entries at all until September when you get paid. And then you record the sale. It'll be a
Okay.
total mishmash. The only businesses that can get by with a cash basis, I think, are real tiny mom and pop type shops. My brother-in-law, my Italian brother-in-law back in Sopranos land, back in New Jersey,
Mhm.
his family owns auto parts stores and they own a pizzeria, places like that. And he works at one of the auto parts stores. And he's not even a high school graduate, but he does okay.
Mhm.
And I remember I always kid him. I said, Artie, how much money do you make working at that store? He said, I don't know. I said, well, how do you get paid? What's your paycheck? He said, well, at the end of the week, we just kind of divvy up what's ever in the till, me and my brothers. I said, how the heck can you do that? I said, how do you pay your bills? He said, well, we pull out enough to cover the bills. We know what the gas is going to cost us. We know this, we know that. The point is, they know their business is very profitable and they can get away with that.
Mhm.
But that business carry, because they're on a cash, I don't even know if you want to call it a cash page. They do no accounting at all, other than having the auditor come in at the end of the year and kind of put things together as best he can for their tax return,
Right.
which I think is a complete bunch of fiction. I'd love to see that tax return someday. But no, where was I going with this? Yeah, as a cash-based outfit, they'll never be able to borrow money. If they want to open up another store, they're not going to be able to borrow money to do that. If they want somebody to loan them money, no one's going to loan them money to do that. So, cash basis is no good. I don't think any school would really teach it.
Okay, so my personal business is I do property management, and then I have a client who I keep track of her finance. So I do bookkeeping for her. So
Right.
both of those businesses are cash basis,
Okay,
right? I mean,
that's fine for her purposes. For
yeah,
her purposes, she's content to wait until she gets paid before recording a sale. That's okay. That's okay with her. It's okay with the world. But like I say, I bet you're never going to see her say to you, "Oh, I just got a loan of $25,000 from the bank." No, no one's gonna lend them money on the cash basis. What cash basis people have had to do is bring in an auditor or some CPAs and restate everything into an accrual basis before they
really.
can. Before they can do business with the real world. Now
Okay, so for
you're
example, she owns properties in the
right.
Boston area. So she gets, rental income, and so she, yeah. So in order, like if she wanted to take out a loan other than like a home equity loan, I guess, um, you're saying that she probably wouldn't be able to?
Well, the home equity loan's a little different because that's going to be based on the property that you're refinancing.
Right. So if she wanted to get a regular loan.
Business loan would be difficult. Now, if you're using QuickBooks, right?
Yeah.
I mean, there's a button there. All you have to do is push it, and it goes from cash basis to accrual basis, right? Have you ever fooled around with that?
No.
Yeah, I mean, it would be interesting. It would be interesting to go in there now and run a financial statement for a particular month, and then tell QuickBooks that you're switching to accrual basis for just a moment, and run those same financial statements. You'll see wild differences.
Hmm.
And they'll both be wrong, because if she's running it on a cash basis, we know that's wrong. And the accrual basis could be wrong because they're never done any, I'm sure they never do any adjusting type entries either.
Right. Exactly.
So, but again, property management is a pretty limited area in that, you own properties, you kind of know what they're worth. So yeah, she could go to a bank and say, I want to borrow $1 million. And the company says, well, let me see your financial statements. And she says, I don't have any financial statements. What I do have is the assessed value of my properties.
Yeah.
So I'm asking for $1 million. This one apartment complex I own is immediately a $20 million building. You know what I mean?
Right.
Yeah.
So she could borrow based on the values of the properties.
Right. And that's totally independent of the financial statements.
Okay.
All right. Well, that's a quick look at chapter 5. This one's a little trickier. We'll go into chapter 6 on Wednesday, and then you have a test coming up, I think October 4 or something like that.
Mhm.
And we'll probably open up that test a couple days earlier for everybody if you want to get started on it.
Yeah, yeah. So the other day I thought, I don't know, I wasn't aware, like, there were 3 quizzes and then the midterm that were
Yeah.
on chapter 1, 2, and 3. So I didn't think I was able to even take them before that day, but I guess I could have taken the quizzes earlier.
It depends. It depends when Cornelia opens them up.
Okay, because I ended up taking all 3 quizzes and the midterm on the same day.
Oh, really? Yeah. Oh, no, the quizzes are part of your homework. That you can do anytime.
Yeah, yeah. Yeah, oh yeah, and then I get a little confused with what exactly is due because I looked on the, I don't know, the syllabus, and then I I I think I'm pretty much keeping up with everything, but then I noticed that I didn't I had done the summary, like the chapter whatever summaries
Right,
of the
right.
chapter 4, but then there was like chapter 4 homework through Cengage, and I missed that due date, I guess. And so,
Okay. Well, you can still catch up with it.
yeah, I did it, but I think I got 25%, whatever.
Uh-oh. Did Cornelia dock you the 25%, huh?
I think it happens automatically.
Yeah. Okay. All right. But you're doing well in the class. We know what your grade is, and just keep moving along, huh?
Yeah, and it doesn't, I mean, as far as grades, it doesn't look like everything's been graded. Like there were some things that had to be, like it wasn't automatic, like I think
No, I have to catch up on the grading. I'm a little bit behind.
Okay.
Right now, I'm doing the grading for 5 different classes, so I'm super busy starting today.
Yeah, that's a lot.
Yeah, today I have this lecture at 9, then I got 11 o'clock, the 2:30 Zoom class that began in August. And then at 1 o'clock, I got the new Zoom class beginning today.
Oh my gosh.
And to confuse things even more, 2 or 3 of my students from my 1 o'clock class somehow thought that because they saw my name with a link to it, they thought the class began during tutoring yesterday at 10:30 when I came out of my class at the school.
Oh.
So I'm sitting there in tutoring, and these 3 people show up, and I had never heard of any of them. I'm like, "How you doing? What class are you in?" And they said, "We're in your class." I said, "Oh, okay. How you been doing? You keeping up with the work?" And there was a real disconnect between. And then I said, "Well, oh," I said, "You're in the new. Why are you here?" And they said, "Isn't this when the class begins?" No. This is when you want to see me for tutoring. If you want to see me for class, come back in 15 hours. We'll work it out. So. But
Wow.
this has been too busy for me, I think.
Really?
Yeah. Plus the new book in 2:30 is causing a lot of adjustments for us.
Hmm.
Everybody's griping about Wiley. We don't like Wiley. All right. Well, I'll
Okay.
let you go then.
All right, thank you. We'll see
All
you
right.
Thursday, right?
We're Tuesday, Thursday people. That is correct.
Yep.
See you
Okay.
then, Gary. Bye-bye.
Thanks, bye.